results of the German election. Will it be the same coalition? Will it be a grand coalition with the SPD? And will it make any difference towards the German attitude towards Eurozone integration? We don't know. Italian government, could it fall in the next few days? Would it survive until after the budget law is passed at the end of the year? Or some people say it might last another 1 or 2 years. We don't know. Certainly there is a possibility that this government may fall soon. Soon next week, soon in a few months. If that were to happen, that will be damaging to the market perception of how dysfunctional Italian politics is. I hope that doesn't happen. There is a risk, there is division of views, and that's a source of uncertainty. There is government and political uncertainty in Greece. Will their government collapse in the next few months? Even they have to do more budget cuts, more reform. There are tensions in Spain and Portugal. Overall, there is austerity fatigue in the periphery of the Eurozone. There is a bailout fatigue in the core of the Eurozone. And the two things could clash. So, are we going to see a process after the German election of faster Eurozone integration, banking union, fiscal union, economic union, emphasizing growth, political union? I don't think so. I don't think the German election will change that, even if there was a grand coalition. The Germans want to go slow on the banking stuff. The fiscal union is not even on the table, Eurobonds and other things. And of course, economic growth is not on the agenda, and political union is going to take a decade. So we're not going to see faster process of integration. And there are many known unknowns about the European Central Bank. They said they may cut rates, but they've not done so. They said they have forward guidance, but it's so fast and vague that it's almost meaningless. They've been talking about credit easing, but they've not done so. So will the European Central Bank become more aggressive? So while the tail risk of the Eurozone compared to a year ago have fallen, the risk of a Greek exit, the risk of a breakup, the risk of Italy and Spain losing market access, spread have fallen, the fundamental problems of the Eurozone have not been resolved. Low potential growth, given slow reform, ongoing recession in most of the periphery, and even if and when Italy and Spain are going to start to grow, IMF does not expect them to grow more than between 0 to 1% for the next few years. And therefore, third point, debt sustainability is still at stake. Take Italy, where public debt is 130% of GDP. Once real rates go higher, as they will, as there'll be normalization in Germany, in the United States, and once growth is less than 1%, you need a primary surplus of 4% of GDP to stabilize the debt ratio at a very high level of 130. Today we are at 2% falling. How are you going to go from 2 to 4? Looks like mission either impossible or difficult. Therefore, the debt dynamic is going to remain fragile, if not unstable or unsustainable. Same story for Spain. Fourth problem of the Eurozone, in addition to low potential growth, mediocre recovery, and debt sustainability, the loss of competitiveness has not been reversed, certainly not in Italy, not in France, where unit labor costs have fallen. They've fallen more in Greece, Ireland, Portugal, Spain, but any strength of the euro undoes that internal devaluation, and part of the fall in the trade current account deficit is not structural, it's cyclical due to the collapse of imports following severe recession. So many of the fundamental problems of the Eurozone remain, even if the tail risks are reduced. On other advanced economies, UK is a bit like the ECB. Their forward guidance is mushy, it's not prevented a rise in long-term and short-term yields. It would crimp their own recovery like the Eurozone, and Carney is speaking about more aggressive forward guidance, but the Bank of England has not done much more. So talk is cheap. Open mouth operations don't mean anything. Either you cut rates or do more QE, or that rise in rates is going to continue. In Japan, they've now won the elections in the upper house. The two big questions in Japan are, will Abe now do the third arrow reform, structural reforms, Trans-Pacific Partnership, and trade liberalization that is key to restore growth? Will he increase the consumption tax next year or not? Should he or should not? Some people worry that if he doesn't, then there is no fiscal credibility. Some people then end up like 98 when increasing the consumption tax led to another recession. Those are the two known unknowns about Japan. Let me move to emerging markets. China. There is still a debate. Is it going to be a softer landing or a harder landing? Will China be able to do the reforms that lead to a reduction in savings, in fixed investment, and an increase in private consumption? There is a third plenum of the Central Committee of the party occurring in November. There will be some reforms, maybe some modest political reforms, some financial reform, some land reform, some change in the system of letting migrant workers get residence, better investment climate for business, maybe a Shanghai trade zone, maybe more environmentally friendly growth. But the key issues are state-owned enterprise reform, they're not going to do it, and more direct policies to reduce saving and increase consumption, they may not happen. And therefore, I'm worried that investment will fall, consumption is not going to increase, that by next year growth in China is less than 7%, by the end of next year less than 6%. It's not a true hard landing, it's not even a soft landing. China is a collective leadership of 7 men in the Standing Committee of the Politburo. Some are reformers, some support the state-owned enterprises, the provincial government, the state sector, the People's Liberation Army. They are resisting reform. You don't have a strong leader like Mao Zedong or Deng Xiaoping who can say, let's go straight left, straight right. They have a collective leadership. All the changes are going to occur cautiously, gradually, conservatively, while China has to move fast. That's why I still worry about the hard landing of China. Now, emerging markets. They used to be the darlings of the world economy. Advanced economy didn't used to grow, but at least emerging markets were growing very fast. Now slowdown in China, in India, in Brazil, in South Africa, in all of the BRICS. Now, these emerging markets did, after their own crisis, reform. First generation reform, fiscal adjustment, macro adjustment, some trade liberalization, some privatization, some foreign direct investment, but they never really implemented the second generation reforms, those that lead to significant structural reforms of the economy. If anything, they moved away from market-oriented reforms towards variants of state capitalism, especially in China and Russia, but even in India, even in Brazil. So some of the story about the BRICS and emerging market was really a myth, was not a reality. And these emerging markets were lucky. China used to grow very fast, you had the commodity super cycle, and money was cheap, zero policy rates, QE1, Q2, QE3, easy money, US, Eurozone, UK, Japan, and all the money searching for yield was going to emerging markets. Now, China is slowing down, commodity super cycle is over, the Fed, however slowly, is going to taper and exit, therefore the party in emerging market is over, and the hangover looks ugly. So, some of these emerging markets have better macroeconomic conditions. Some of them, even important ones, are weak. Indonesia, India, Brazil, South Africa, Turkey. These are big, systemically important emerging markets, member of the G20, that have current account deficit, fiscal deficit, low and falling growth, high and rising inflation, and now social and political protests, instability, and election in the next 12 to 18 months. Now, there are some positives that suggest that you're not going to have a repeat of the emerging market crisis of the 10, 15 years before. Exchange rates are more flexible, they're sitting on hundreds of billions of dollars of reserves, and there's less liability dollarization and currency mismatches. So maybe a severe crisis like the Asian one, or Argentina, or others that occurred 10, 15 years ago may not occur. However, there are negatives. They have a policy dilemma. If they increase interest rates to avoid the currency free falling and causing higher inflation, they're going to kill the growth, they're going to damage banks and corporates. So that's going to be a negative. Interest rate defense, and it's not going to be credible, especially as you have election coming and they cannot afford low growth, let alone recession. If instead they cut policy rates to boost growth, the currency will go in free fall and then jeopardize the financing of large current account deficits with lower interest rates. So damn if you do, damn if you don't. And if you lose a nominal anchor by reducing interest rates, you could have a free fall of currency that feeds into inflation, into more currency depreciation. So you could get into a bad equilibrium. Therefore, there are no easy choices for these countries. And you have these elements of political instability, protests in Turkey, protests in Brazil, strikes in South Africa, uneasiness and political instability in Indonesia where you have election, or India next year as well. So that's not going to help in terms of having a coherent macroeconomic policy framework or accelerating reforms that they didn't do in good times, let alone being able to do them in bad times. Let me conclude with some observation about geopolitical risk of the matter. There's the Middle East. It's the risk of Syria. If there is an attack, if the attack is not limited in time and scope, oil prices could go higher for longer, and the last thing that the global economy needs right now is another spike in oil prices. It would be negative for US, Europe, Japan, China, India, and all economies that net oil and energy important. Hopefully it will be limited in strike if it does occur. That's another known unknown. Israel and Iran. Israel has been waiting patiently for over a year for negotiation and sanction to work. If they don't work, Israel may attack. Maybe even the US may attack. You have the Arab Spring countries, Egypt, Tunisia, Libya. Rather than Arab Spring looks like Arab night or a nightmare with social, political, economic fragility. The entire Middle East from Morocco, Algeria on one side all the way to Afghanistan and Pakistan looks like a source of geopolitical instability. People worry about the Middle East, but there are also territorial tensions in Asia between China and India, and Japan and Korea, Philippines and Vietnam, territorial issues on land, on islands, and so on. Those could escalate as you don't have institution for cooperation. And of course, the biggest geopolitical issue of our times for the next decade is going to be the relation between the current superpower, United States, and the new rising superpower, China. And if you don't manage carefully and successfully that relation, the rise of China will occur, hopefully be a peaceful rise. If it were not a peaceful rise, it would create a series of geopolitical issues. That's another known unknown. To summarize, there are some upside risks, there are some downside risks. Some of these things that are risks may turn out better, some of them may turn out worse. If more of them turn out better, the global economy market is going to improve. If many of them turn out wrong in terms of policy mistakes, political mistakes, policy uncertainties, many things could go wrong. Compared to a year ago, the tail risks are lower. A year ago, we were worrying about Greek exit, Italy and Spain losing market access. Thanks to ESM, that's not the case. A year ago, we were worrying about US fiscal cliff of 4% of GDP. A year ago, we were worrying about China hard landing, or about the war between Israel and Iran. Those tail risks have been reduced, but have not gone away. The Eurozone is still a mess. The US has all these uncertainties, including those on the fiscal. China now has a harder landing, and it's not just China, but now most of the EM have these harder landing. And the geopolitical issues, including Israel and Iran and the Middle East, are as bad as they were a year ago, maybe worse, as even the Syrian conflict could become a regional conflict, affecting the stability of Jordan, Lebanon, Iraq, Turkey, and the region. Two final observations. There is a meeting of the G20, but my friend Ian Bremmer was here, head of Eurasia Group, is a political scientist, and I wrote 3 years ago an article in Foreign Affairs saying this is not a G20 world, it's a G0 world. It's a world in which the great powers diverge in their views, in their economic, political model. They don't agree on anything, on monetary policy, on fiscal policy, on current account imbalances, about exchange rates, about how to reform the financial system, about the international monetary system, about global climate change, about trade liberalization, and about, of course, geopolitical issues. So it's not the G20, it's the G0, and what has happened last night with the debate on Syria suggests exactly that. Second observation and final one, the people at PINCO say we live in a world that is a new normal. I recently wrote a paper published in Institutional Investor again with Ian Bremmer, where we said this is not the new normal, it's a new abnormal. Because you have tension in advanced economies, you have tensions in emerging markets, there are lots of sources of uncertainty, volatility, and risk. They are economic, macro, fiscal, regulatory, taxation, financial, but increasingly also risk and uncertainty that are political and geopolitical. As I said, not everything has to turn for the worse. There is hope that policies at the national level and some degree of international coordination in spite of the G0 is going to reduce those tensions, but there is a risk that then policies at the national level are not the right ones, and at the international level there is not enough cooperation and coordination to achieve a better result. So we live still in a world of risk, volatility and uncertainty, where there are plenty of known unknowns, let alone the unknown unknowns. And I'm not going to talk about unknown unknowns right now. That will be an overall summary of the remarks that I made. Thanks a lot.